Shares in Man Group are trading higher after the largest publicly traded hedge fund manager said that assets under management rose during the second quarter. Redemptions slowed in the 3 months to September, while currency movements also helped to boost figures at the group. Earlier in July, Man Group said it expected to return to net client inflows heading into 2010. This news comes as a new report shows that total assets under management in the UK fell by 12% last year after 5 years of successive growth. International Financial Services London says that profits at fund managers will continue to remain low this year as challenging market conditions persist. Marko Maslakovic is a senior economist from International Financial Services, and he joins us for more. Hi, Marko.
Hi.
So in your own words, what have you found in this latest report?
Well, the fund management industry has been affected by the global economic downturn, as have other sectors. Perhaps it wasn't affected as much as, for example, the banking sector, but assets under management have suffered a big decline in 2008. And actually, trends in the UK pretty much mirrored the global trends. Global conventional investment management assets fell by about 1/5 in 2008 to around $60 trillion. And when we say conventional investment management assets, here we're including pension funds, mutual funds, and insurance companies' assets. If we add the private wealth and alternative funds as well, the total approaches $90 trillion. There were several reasons for the fall in 2008. Firstly, the declining returns, the big falls in equity markets, which fed in through to negative returns for fund managers. There was also an increase in redemptions and a reduced inflow of new funds. And all these things combined to influence the fall in the assets during the year.
And can you read into your report whether or not profitability is set to remain lower for this particular area of the financial services?
Well, profitability has fallen quite a bit in 2008. Actually, fund management margins fell from 32 basis points to 23 basis points, which is a big fall in 1 year. Again, fund managers have responded by cutting costs. They've, in some cases, reduced staff levels. In the UK, employment in fund management fell by about 3% during the year. There was centralization of back office operations, increased outsourcing. There was increased mergers and acquisitions activity as well. But nevertheless, revenue fell more quickly than costs. And this is not really likely to turn around this year because assets under management are still at lower levels than in the previous years, and it may take a couple of years before they return to the pre-crisis levels. Also, investors have switched to asset classes which generate lower fees for fund managers, such as passively managed funds like ETFs rather than equities.
Yeah, I think that's interesting because from what we're hearing, or from what it sounds like if you look at the headline level, everybody and their grandmother is in equities at the moment, and it wouldn't seem like people are switching to those asset classes that you just mentioned.
Well, I think that's particularly the case in the UK, US, and Australia, where institutional investors typically allocate a bigger proportion of their funds into equities. But there is a sort of long-term trend where this is declining, and it has gradually increased since the beginning of the credit crisis. It may be slowly stabilizing because the equity markets have put in such good performance since March.
When do you think that the asset managers are going to be able to charge higher fees again?
It may take a couple of years. There's less business at the moment, so there's more competition for existing business. I think once the risk aversion sort of exits the market, we may see investors entering more risky assets, and that feeds through to higher fees for fund managers.
You're nodding a bit, Sonia.
Yeah, I mean, I think there's an overall cleanup process underway, because I think we all agree we have too many products anyway, be it passive, be it active, be it certificates, be it whatever. It's just far too many products that have been exploding. The number of products has been exploding over the last couple of years, and I think we all agree we don't need all of them. And I think every asset class has its place, and to be fair, you know, when you look at the flows overall, then I think in particular the corporate bond story has attracted a lot of interest, and you know, some of the passively managed and in shorter term certificates have attracted a lot of interest. But I think it's a process that is underway that will allow to restore profitability over time, but obviously it's a process that will take a couple of years, because normally kind of product closures and, you know, this cleanup process is not happening in 2 quarters.
Thank you very much, Marko. Maslakovic, is that right?
Yes.
Maslakovic?
Yes.
Say it once.
Maslakovic.
Maslakovic, senior economist from International Financial Services. We appreciate it.